Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. Today I wanted to talk about rebalancing your portfolio. As a way of getting into that topic, I wanted to review a chart that I showed last week. This, of course, is the S&P 500 year-to-date performance. You can see a big decline in early April on the tariff announcement, and then a big rebound just a few days later on the announcement that tariffs would be postponed or delayed. So the market was down about 15% from the start of the year through early April, and now it's up from that bottom about 27 or 28%. Altogether, that's up about 9.4% for the year. This is the S&P 500 TR, or Total Return Index, which includes dividends. So a very big swing in the index this year. You can see just from this chart alone why it's important not to panic. That's not to say that things will continue on the uptrend for the rest of the year, but if you had sold out at the bottom, that would have been pretty painful. You would have missed a big rebound. So wanted to show one more chart before we get into rebalancing. This chart shows three different versions, let's say, of the S&P 500 index. The green line is the equal weighted index. So take the top 500 stocks, but don't weight them according to their size or market capitalization. Equal weight them. And this index for the past 3 years, this is a 3-year chart, shows that index is up about 40% cumulatively. We indexed this to 100 3 years ago. So you can see that green line is at about 140 now, all the way to the right. You're up 40% over 3 years. Not a bad return, but certainly not the best return on this graph. The red line is the plain S&P 500. Again, the TR version, including dividends. That's up over 160 from our initial indexing it to 100. So you're up over 60% in the plain S&P for 3 years. And this is 3 years through Friday, July 25th. The blue line, the one that has done far and away the best, is the S&P 500 Top 10 Index. So you can see how well the top 10 stocks in the index are doing. You're up more than double for 3 years. So over 200, I would call that about over 215, let's call that 217. So you're up over 100% for the 3-year period. Moves like this can take portfolios out of their target allocation. So now let's get into rebalancing. You can see 2 years ago on this chart that a 60-40 portfolio, and we're not using the S&P here, we're using the global stock market. So this is a 60-40 index all the way on the left with the global stock market and U.S. bonds. Starting 2 years ago, July 25th, 2023. A year ago, if you left that portfolio alone, if you didn't rebalance it, the stock piece grew to 62.5%. You can see in this middle bar of the chart, and the bonds decreased from 40 to 37.5. That's not too bad. Maybe you didn't need to rebalance for a whole year. It's a big question, actually, that advisors and investors have, how often to rebalance. I would say probably no more than 4 times a year. But then the question is, do you do it on a preset schedule every quarter or semi-annually, or maybe once a year annually? Or do you try to do it opportunistically when the market goes up a lot or goes down a lot? There, of course, you're employing some human judgment and doing some amount of market timing, but everyone has to decide that for themselves. So moving along to the third bar on the right, this is after 2 years now through Friday, July 25th, 2025. Your original 60-40 allocation is now 65.7% stocks, and the bond allocation is down to 34.3%. So I think a 5 percentage point move away from your target warrants a reallocation or a rebalancing. We're not doing anything fancy here. We're not adding other asset classes, just good old global stocks and domestic bonds. But in merely a 2-year period, this portfolio is now out of whack, assuming it hasn't been touched. So probably time to rebalance. Take note that if you have money in a taxable account, rebalancing will cause you to incur taxable gains. So selling the stock position off by 5 percentage points and moving it into bonds, you're going to pay taxes on the gains. So it's helpful to rebalance as much as you can in IRAs and tax sheltered accounts. At the same time, I would say don't let the tax tail wag the portfolio dog. As advisors like to say, if you're paying taxes, you're making money. And you don't want to get too far over your skis in your portfolio allocation. You don't want to let this get to 70% stocks if your target allocation is 60%. You're at 65.7 now, call it 66. I think that warrants a rebalancing or a reallocation. As always, consult with an advisor. Be mindful of the tax consequences of doing this sort of thing, but it is important to rebalance. A lot of individual investors like to let their stock positions run, sometimes with some justification, but sometimes in a way that can cause you sorrow in the end. So I think if you've let your portfolio alone for 2 years, time to consider rebalancing. Anyway, John Kumarianos for Capital Considered signing off. Thanks for watching.